I see a lot of people on YouTube who buy shaky looking stocks, who hold poor quality stocks in their portfolios. And I just think to myself, why are you buying that? What is the purpose of that investment? It doesn't pay a fantastic dividend, it's not a growth stock. And I just think there are a lot of people buying poor stocks because they see their share price is really low compared to their historic highs. And they think it can only go back up. But most of the time, a stock is low for a reason, and low can always get lower. And I think there are two reasons why people do this. There are the traders out there who are looking to buy beaten up stocks who may be down 7, 80, 90%, and they're looking to catch that big wave back up when they bounce back. And then there are people who are buying poor quality stocks just because they've heard of that brand or that company and they think it's a safe bet. Well, that's not always the case either. So in this video, we're going to be taking a look at some of the most common stocks people are buying that, in my opinion, don't make good investments. Are any of these stocks in your portfolio? Stick around to find out. So hello, welcome to the channel. My name is Henry, and today we're going to be talking about crappy stocks. Yep, really crappy stocks that people just seem to keep buying, usually in the hope of making big short-term profits. And a lot of retail investors have made a lot of money recently buying heavily beaten down stocks and riding a wave back up. And in some cases, retail investors are even outperforming hedge funds, which is brilliant and also quite funny. But there also seems to be a trend developing of a lot of money flowing into poor quality stocks with low share prices in the hope of big short-term gains, meaning a lot of people are acting as traders and not investors, probably without even realising, which is worrying and could end up with people losing a lot of money. Before we get into specific stocks, let's look at this in action. You can see from the charts, Robinhood investors are buying an awful lot of shares of stocks with the poorest balance sheets, as demonstrated by the gold line. Why is this happening? Well, usually because these stocks have very low share prices compared to their historic highs, and hence people are hoping to ride a big wave upwards, as we saw recently with Hertz. However, this doesn't always happen, so what are you left with? You're left with a lot of people owning a lot of crappy stocks, which is not good news. I also think there are a lot of investors out there who buy into stocks because of the company name or because of the brand which they know, they trust, they've grown up with, but they haven't actually done any research into the company's fundamentals to understand whether they're actually a good company or not. And I think that is shown by the chart on the screen now, which shows the 5 different stocks or most widely held stocks between institutional investors and retail investors. Now you can see the retail investors' 5 stocks include Ford, an automotive company, General Electric and Industrials, 2 airlines, and then Walt Disney. Now all of these are very well-known brands, probably companies which a lot of people use themselves, and therefore are companies which people feel comfortable investing in. However, all these companies, probably with the exception of Walt Disney, are really struggling in terms of their current share price, their profit margins, and their outlook going forward. Now, the makeup of stocks held by the institutional investors differs massively. You can see Visa and MasterCard on there, electric payments company, Adobe, PayPal, fintech stock, Google, Alphabet, which is obviously the search engines, quite tech heavy and forward thinking, and a lot of these companies have got really good growth potential, unlike the retail investors' picks. Now, before we move on and start looking at some of the individual stocks and sectors, if you've enjoyed this video so far or you take some value from it, please show this channel some support by hitting that like button and also clicking the subscribe button. Your support will be very much appreciated on this new channel, which we're just trying to get going. So let's move on and look at some of the individual sectors and stocks, which a lot of people seem to automatically include in their portfolios without doing their research. Building off the last slide, the first one I wanted to highlight is Ford. But actually this could be a number of traditional auto manufacturers who have been really slow to keep pace with the move towards electric cars, which is 100% the direction of travel. These companies have seen their existing models or sales of their existing models decrease, while companies investing in EV, electric vehicles, have been growing market share and fast. This is shown in their share prices, which have been on a downward trend for some time now, whereas companies like Tesla, on the other hand, have shot up. Now, I'm not saying go buy Tesla, but maybe you should go buy Tesla. The point I'm making is that a lot of traditional car manufacturers are being left behind. It goes back to my original point at the start of the video. These companies aren't providing you with a dividend, they're not providing you with really good growth prospects, and the market outlook in general for some of these companies that have not kept up with innovation is really bleak. So why would you put your money in there when there is a lot of better alternatives? And the answer is probably because that's what people have done historically. That's what a lot of people having their portfolios, and there's probably a lot of people hanging on to those stocks because they're waiting for that share price to creep back up again before they exit. Well, as new investors, we should not be entering those stocks, and I see a lot of people making that mistake. The next industry and selection of stocks I wanted to talk about is oil, whose success, of course, is very closely linked to the automotive industry, as a decline in the use of the internal combustion engine decreases the need for oil. Yes, there are other uses for oil, but transportation uses make up over 50% of the demand for oil, so quite a large proportion. Now, oil companies such as Shell, BP, Exxon have been a staple in portfolios for decades, and as a result, people continue to buy them to make them a part of their current portfolios. But why? Their dividends are being cut left, right, and centre, as recently showed by Shell. Their growth prospects are non existent, and the company's success is determined by the price of oil, which they have no control over. It's not like Apple, who set the price of the next iPhone at whatever they want. Oil companies can't do that. And with demand decreasing, the price of oil is going to continue to decrease alongside that, reducing the profits for those oil companies moving into the future. So like with some of the auto stocks we looked at, let's look at the share price of Shell as an example for the oil industry. Now you can see its share price over the last 20 odd years really hasn't moved much. At the moment it's obviously an all-time low, but that's due to COVID. But even before that, its share price was not growing fantastically well at all. Now a lot of people included it in their portfolios for the dividend yield, but with dividend yields being cut, I would question why people continue to hold it in their portfolio. There are good stocks out there that do pay a good dividend, but which also offer good growth prospects, because they're in an industry which is on the rise as opposed to oil, which is falling. Right, now moving on to the third and final sector that I wanted to highlight today, and that is the supermarket industry, which could actually be expanded into the wider retail market, but I just wanted to focus on the supermarkets today. Now, there's no doubt all four of these companies are huge and they have great influence on our everyday lives. Everyone knows them and most people will shop at one of them, which creates brand loyalty and leads to a lot of customers owning or who are willing to own their shares. The problem with supermarkets is there is such massive competition, which drives down prices and hence their profit margins are so tight, especially the big four pictured, which excludes Waitrose, M&S and obviously the discounters Aldi and Lidl, which have had a really big influence on driving those prices down. So the profits are fairly low and with little potential for them to ever increase by any significant margin. Now, similar to oil stocks, one of the benefits to supermarket stocks historically is the dividend. Tesco's currently pays 4%, for example, which is the highest, and Morrison's pay the second highest, which is 3.6%. The problem is profits are being squeezed, leading to very high payout ratios and a high likelihood of those dividends being cut or suspended. Tesco's, for example, whilst it has a high dividend yield of 4%, its current payout ratio is 96%. So they are paying out almost all of their profits in dividends. Now this is an issue for two reasons. One, any changes in revenue can push their payout ratio over 100. And two, it doesn't leave any room to reinvest profits into the business for innovation, training, new stores, etc. So whilst I would say supermarkets aren't a sector on the decline, like some of the automakers and oil stocks we covered previously, I would say it's an extremely competitive market with very low profit margins, which again caps growth potential and also puts dividends at risk. For that reason, this is another industry I am staying clear of. So hopefully you found this video interesting and it's given you something to consider if you're looking at buying into any of these stocks or whether you already hold them. It would be great to hear your opinions on this video and whether you agree with the choices or not. You will not be surprised to hear that I don't currently hold any of these stocks in my portfolio, but if you do want to see what I have in my portfolio, go look at my last portfolio update video. I've left the link in my description, so go check that out. Otherwise, the only thing left to say is please drop this video a like, please subscribe to the channel, your support will be much appreciated, and I hope to see you in the next one.